Hey, what is up, traders? What's up, tycoons? Super excited for today's video. The January effect refers to the hypothesis that in January, stock market prices have the tendency to rise more than in any other month. The market tends to be green about 75% of the time, I believe, in January. And so, is it possible that the Christmas rally gets extended into next year? We'll have to see. We'll dive into a lot of information. We're going to break down some charts for you guys. Of course, TLT, everyone's favorite bond ETF. We'll also take a look at the 10-year treasury yield, which is going to be pretty important. We're at a critical level right now. And I know everybody always says that, but there's two scenarios here. We're looking for a potential look below and fail, or to see if we're getting the breakdown, retest, push lower. We'll have some clarity over the coming week or two. We'll also break down the SPY. My favorite chart pattern, the inverse bump and run, played out very beautifully here. And it was a great opportunity to go long on the SPY when we were back here at these levels with the stop loss below 411. MMM is another chart we're going to take a look at here. Okay. We'll go over some individual names and also Tesla. Okay. Some interesting setups. And I just want to bring some more stocks rather than just the SPY and just the, TLT to your attention. So we'll go ahead and do that. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. I started a completely free newsletter for you guys, Investment Intelligence, giving out free trade ideas, free finance content, free trading content. You can get those emails sent straight to your inbox, highlighting the conditions that we're looking at on the chart, showing you guys the chart, and many of those trades have worked out very, very great. Okay, I try to give out high quality setups, high quality trade ideas, such as this one here with the rising wedge, highlighting the targets to the downside. And you can see how that trade played out perfectly. If you're fans of free, valuable trade ideas, free, valuable content, you can sign up for that, get those straight to your inbox. But right now, they're still running the flash sale on the Investment Intelligence Discord. Okay, you can get in for just $1. That deal is going to expire today. It's the first sale that we've run on the Discord. The Discord's been around, maybe 2, almost 3 months now. Big plays in there. Okay. Carnival Cruise Lines was one of the stocks we were looking at. Carnival was not in the newsletter. It was one of the other stocks in the analysis. You guys remember that huge day that IWM had over the last week or two. It rallied tremendously, had one of the largest green days it's ever had in its history. And we actually got into IWM right before that. Okay. So, if you want access to all of the different trade ideas, all of the different analysis and resources, use promo code Black Friday, all caps, no space, and that will get you into the Discord for only $1. Now, let's get into the video. And before we hop into the charts and the technical analysis, there's some data that I want to share with you guys. Right now, when it comes to monetary policy, we're seeing more central banks are now cutting than hiking. This is the first time that this has been the case since 2021. And so a lot of U.S. equity investors and speculators are basically speculating that, hey, well, if more central banks around the globe are cutting than hiking, that's a sign potentially that we're going to start getting rate cuts sometime soon from Powell, right? From Papa Powell. And so that's being priced into the market right now. If you go and take a look at, basically the Fed rate probabilities, we can see that the probability of a rate cut keeps getting shifted closer and closer and closer in time. Okay, so that's been one of the things fueling the rally. Okay, has been the earlier pricing in of rate cuts. Now, it's really interesting that that's happening, okay? Because if you look at inflation expectations, we have the 1 year and the 5 year here. Inflation expectations rose the 1 year to a 7-month high, while expectations for 5 year inflation remained at the highest since 2011 at 3.2%. So, we're seeing a little bit of an uptick in the inflation expectations here. So that is interesting to see, but a large part of why the market's been rallying is because they're pricing in those rate cuts. So if these inflation expectations continue to tick upwards, we may see the market pull back as they kind of slow down on pricing in the rate cuts, and maybe they go back to, understanding and kind of believing Powell a little bit more about the higher for longer theory. Now, this is a great chart right here. It shows the Fed easing / credit tightening cycle. And this has historically been the worst environment for equities. Now, which one? It's this one right here where the Fed is easing and there's credit tightening, right? And so why is the Fed going to be easing? Well, the Fed is going to be easing and basically cutting rates most likely because we're in a recession or something is very wrong with the economy and we're perhaps on the midst of a recession. Okay, so while stock markets can be rallying now, pricing in those rate cuts, when the Fed actually does cut rates, oftentimes it's not the best thing for stocks. So you do want to be prepared for that and kind of, understand the narrative that's going on. The market's rallying before rate cuts happen. And then once rate cuts happen, then they may start looking forward and pricing in something different. And it's possible you could see a pullback in the market. Now, there are other cycles, right? So when the Fed's tightening and credit is easing, you can see the results are very different. The average return is about 1 month, or I'm sorry, 1%. These are all monthly returns right here. When the Fed is easing and credit is easing, the average return is about 2%. So this is the most bullish right here. So let's say the Fed cuts, but credit is also easing here. That's going to be really bullish for the market. And then you have Fed tightening and credit tightening. The average return is about 0.1% per month. And then with the Fed easing and credit tightening, the average return is negative 1.1%. All right, let's look at consumer debt here. All right, it climbs to $17.3 trillion. Now, a lot of people look at this as a huge problem. And while it is something definitely to be concerned about, I do want you guys to just notice that the trend is always going to be up, right? There are periods where it starts to decline, but U.S. debt is really just going to continue growing, whether it's federal debt or, consumer debt. And it's a very simple concept behind that, right? As people are making more money and as inflation is going higher, typically they're not going to change their spending habits, right? So the credit cards, if they're making more money, they're going to be spending more money on their credit cards. If they're making more money, their people are going to be, buying, more expensive cars. Okay. And as the price of everything is going up, the loans for all of these things are also going to go up, right? So, I mean, consumer debt is honestly just going to keep climbing. There may be some type of corrective period, such as we see right here, where it starts to go back down. But overall, I mean, this is something that's going to keep rising, right? And the higher the number gets, the more shocking and the more shock value it's going to have to people. But just understand, why debt is going to most likely keep going up, and basically just understand that concept, right? Now, when we look at the consumer dashboard, we continue to see consumer spending as a source of strength in the economy. And obviously, this is going to be really important because the consumer makes up about 70% of the economy, right? Of GDP. So, seeing a strong consumer right here is good. But one thing there's lots of stocks that are benefiting from this, especially when it comes to retail sales. That's something that we saw a bullish surprise in recently. And, really what you want to pay attention to is the stocks that are going to benefit from these retail sales. A lot of people are not necessarily actually buying these things outright. Online sales are skyrocketing, right? And we just saw the largest online sales for Black Friday, which is not a surprise really. But what is surprising, what people aren't factoring in, is they're not actually buying this stuff outright. They're going into debt. Now, whether it's credit cards or a large portion of sales are through a firm now, right? The whole buy now, pay later system. And that's why we're actually really seeing this Affirm stock skyrocket here, even though a lot of people are worried about a recession. Now, if we look here, this is, basically the consumer dashboard part 2. Okay. And, we're just seeing lots of strength. Okay. But there are a lot of things to be concerned about. Right here, we have the unemployment rate. And so the unemployment rate is ticking up. If we look at the delinquency rate for credit card borrowers, right, delinquency rate is all going up right here. Consumer sentiment has actually been rising, but it was down there in the trenches. But consumer sentiment's been rising here. If we look at the net job gains, which I kind of just wrote about this in the recent newsletter, but the labor market is softening up here a little bit. Okay, it's still pretty strong, but it is softening. Wage growth, and basically the increase in wages is below average right now. All right, and basically like the percent that people are getting a raise and that percentage of the raise towards what they were previously making is below trend right now. And we're seeing unemployment tick up and we're seeing the delinquency rate tick up. And remember, when the Fed cut rates, it's usually because something's broken in the economy. So right now we're still seeing a strong consumer. But heading into 2024, if we continue to see delinquency rates rise, if we continue to see unemployment rate rise, if we continue to see the labor market soften up, that's going to be a sign that, hey, maybe we are getting closer to this recession. Maybe we're in the recession in 2024, and maybe that's why the Fed is cutting rates. And then you want to understand how the market is going to react to that, right? If you take a look at 60-day loan delinquency rates, also going up right here as well, for auto loans and subprime auto loans. Now, the Bloomberg Magnificent Seven's ERP is already deeply negative. The remaining stocks proxied by the S&P 500 equal weight index are less expensive, but at around 140 basis points, they're not exactly cheap right now. And Wall Street recommends basically asset allocators are bearish stocks and bullish on bonds. And I believe Bill Ackman was famously short treasuries. Okay, and then of course they tanked. He closed his short and then talked about going long, right? And so oftentimes these hedge fund managers, these asset allocators and different things, they're all kind of in cahoots with each other. And so, they'll follow someone like Bill Ackman. And so when he's short, when he's bearish, they're all bearish on, on bonds. And now that he's long, it seems like they're all bullish on bonds now as well. Okay, so you do have to kind of take that stuff with a grain of salt whenever you see those major headlines and ask yourself, what's the purpose that they're putting this out right now? Is there a narrative behind the story? Now let's get into some charts here. And TLT is still looking very strong at the moment. Okay. We talked about the possibility of it just being range bound. Okay. And, basically 91 to about 83 would be that range right there. And remember, there's 3 stages to a reversal. Okay. You have the downtrend, then you have box consolidation, and then you have the actual reversal itself. So we've been in a tremendous downtrend for years in TLT, and it's possible we're establishing this box consolidation right here and attempting to get the reversal. Okay. Now, if we were to pull back, 91 is still that strong resistance, 91.03. All right. We have support here at 89.21. If we were to pull back and consolidate through here, that would start forming a handle, right? We have a nice cup forming here, and that would start forming a handle. Could also be bull flag consolidation, however you want to call it. Just depends on, what patterns you want to chart and what patterns end up developing. So right now, 91.03 and 89.21, that is basically our consolidation area that we're stuck in right now. And we're looking to see, are we going to break above or break below? If we break above 92.30, 94.74 are going to be strong areas of resistance. But we have a nice gap up here to fill right around $96, which this is our 200-day moving average. And this is going to continue heading in this fashion here. And so it's very possible that, if we do break out, we come up to this 96 area, which is going to be right along the 200-day moving average. That will be lots of resistance there. And it'll be interesting to see what happens. If we can, reclaim the 200-day moving average as support. There's lots of funds and institutions that simply are not allowed to long something unless it's above the 200-day moving average. So if it reclaims that, it's possible we could see more money flow into things like TLT. Now, you want to keep in mind that just because more money flows into TLT and stuff like that, it doesn't necessarily mean that the price is going to go up. The price is affected by treasury yields. Okay, so when we take a look at TNX and the treasury yields, a large reason we saw this huge skyrocketing in treasury yields, which results in bond prices going lower, was a supply issue. Right, we had our 3 biggest buyers of bonds basically walked away from the bond market, right? Number one, obviously being the Fed. They're doing quantitative tightening versus quantitative easing. So they're no longer buying up US treasuries. Then you have Japan and China becoming large sellers of US treasuries. So that really affected the bond market, and that helped fuel the rally to the upside. Now, it's been following the analysis pretty well. We mentioned how there is a gap down to fill on TNX, and we did come down and fill that gap. And so now, we were talking about 2 scenarios there, right? Is it going to be a look below and fail? And that would be bullish for treasury yields, which would be bearish for TLT, or is this going to be a break, retest, and push lower? If we go lower, 4.187, 4.128, those are going to be some of my targets to the downside. Again, the 200-day moving average will also be creeping up here. So that kind of aligns with, if we get the retest, the retest and push lower, that kind of aligns with TLT going and reaching its 200-day moving average to the upside. Now, if we get that look below and fail scenario here that's bullish on the 10-year treasury yield, for support, you're going to have 87.94, 86.89, 85.84, and 85.05. Notice how there's this blue box right here. These are gaps, okay? The gaps on the daily chart. it is possible, for TLT to still be bullish and come down and fill this gap. Again, that would give us this cup and handle pattern right here and give us a clean handle if we can find support around 85 and above 85 and then break out above 91. So that's the main things that I'm looking at when it comes to the bond market. When we look at SPY, the S&P 500 ETF, I keep mentioning this chart pattern. I've mentioned it all year. Inverse bump and run indicated by this prevailing downtrend and then this aggressive bump down in price. And then here is the run. It's been my favorite chart pattern of 2023. Played out very nicely in a perfect world scenario. It takes you back up to where the pattern began, and you can see we're consolidating now above that supply. So the big question here is going to be, are we going to get a breakout retest and push up higher? Ultimately, I think it's possible that the SPY can make new all-time highs and head up to 475 is going to be the target. That's not going to happen overnight. It's not going to happen very quickly. I've gone over many melt-up theory videos and data to show you guys the data behind the theory. But I do think it's possible that, even if we pull back, and we just consolidate, I think it's possible that we get that melt up and kind of just gradually grind up higher. The melt up would take us to about 462 by the middle of December. So we'll see if that melt up theory is going to play out and we get to 460 or above in December. But ultimately, if we want to go higher, all right, and if we want to make new all-time highs, it is possible. We'll see though if the SPY is going to be able to come up and hit this 475 target. Probably that would be maybe in that January time. Remember, in the very beginning of the video, we talked about January potentially being bullish. And so, if we get the Christmas rally and then it extends into January, it's very possible that, we could hit that 475 or potentially even go higher. You do want to be mindful though, and use some form of risk management. We have 1, 2, 3 gaps down on the SPY daily chart from this huge rally that we had from 411 all the way up to 453. So it does make sense if we were to get some type of a pullback. And look what happens if we were to even pull back all the way and retest this initial prevailing downtrend that we had. That would fill 2 of the 3 gaps down below, and our 200-day moving average is also going to be rising up in this area. So there's going to be lots of support potentially if we do pull back around that 430 to 435 area. It's going to be a really interesting area. Okay, never short a quiet market. And this is what I mean. This is a quiet market, right? It's really just chopping right now. You want to look for some type of confirmation of bearishness if you're a bear. Obviously, if you've been trying to short these moves up when it's been extremely strong, it's been very painful for the shorts. And then, right now we're kind of getting a quiet market, and you don't want to aggressively, short a quiet market because at any time, it's very possible for the market to just absolutely explode. Right over here, it was a quiet market, just range bound, and then we saw a huge green day afterwards. So maybe you could look, if you're a bear, for a break of this trend line, target the lower range of that previous supply zone. Okay, or if we break a longer term trend line, something like this, you can look to target the gap fill, different things like that. But ultimately, from about 454, we'll call it, to about 450 is going to be a key area for us where we could see consolidation before we get the next move, whether that move is to the upside or to the downside. That's basically your range that you want to pay attention to. If we look at MMM, I think is possible. We could be seeing an ABC correction here, right? An ABC to the upside. A wave is typically a 5-wave structure. C wave is typically a 5-wave structure. And then your B wave is typically a 3-wave structure in the form of an ABC. So we got to clean 1, 2, 3, 4, 5 up. Okay, we got an A down, B up, and it's possible that this stock could drop lower. There is a small gap to fill. So that's a potential setup, right? If this stock drops lower and tries to fill that gap around 92, then I'll be pretty interested in it. Okay, and we also have $90.96 right here is going to be as support. So if it comes back to that 92 to $90 area, then I'll be interested, and you can set up a pretty good risk to reward trade there to potentially catch the C wave up. All right, and have a stop loss shortly below. That's definitely a stock that I'll be watching. The next one is going to be Tesla. Okay, Tesla also had the inverse bump and run here, right? So prevailing downtrend and then aggressive bump down in price, broke out of the pattern. Within this, larger though, this is a wedge, right? So this large wedge that we have here is still forming, is still playing out. and we're looking to see if it can break out of the larger wedge. But within that larger wedge, we have the inverse bump and run, and we also have a much smaller wedge right here. You can see Tesla actually came down to the bottom of that trend line here today and started rebounding. So, the first step we would look for is a break of this smaller wedge here to help fuel the rest of the inverse bump and run. And then, like we talked about, the inverse bump and run typically in a perfect world scenario will take you back up to where the pattern began. So that can take Tesla anywhere from 285 to about 300, if that inverse bump and run plays out and takes us there. And that also would align a little bit with a wedge breakout. So that's one of the main things I'll be looking for in Tesla is, can we break out and maybe even get a breakout retest of the trend line of the wedge and then push up higher to that 285 to 300 area? That's definitely something that I'm watching right now. All right, don't forget to join the Discord right now. The code expires tonight on Monday. Promo code Black Friday, all caps, no space. That will get you into the Discord where you can get access to all of the different trade ideas, all of the different analysis and resources that we have available inside of there. If you don't want to sign up for the dollar, entry into the Discord, that's only available today. Sign up for that newsletter, okay? You're not going to regret it. If you like free, valuable content and free trade ideas sent directly to your inbox, you can sign up for that newsletter and get those every single week. And if you enjoyed today's analysis, you can go to my Ko-Fi page, link in the description, click on commissions, and there you can book a 30-minute or 1-hour session. Oftentimes, people want a little bit more clarity and sometimes have questions and different things like this. So, I do a lot of these coaching sessions. They're available in 30-minute or 1-hour sessions via Zoom. All right. You can also request a YouTube video on the topic of your choice, or you can click on this buy a coffee button basically as a way to leave a tip or donation for the free valuable content I put out.